Joining us now to wrap up our State of Investing series is Chief Investment Officer Faruqi Majid. Thank you for joining us. How'd you do it? That's a very impressive return, more than 26, almost 27%.
Well, thanks for having me. So, this year I think you'll have strong performance from most pension funds. Equities have done tremendously well, more than 40% returns in the U.S., as much as 50% that we've been able to garner in emerging markets. So that's the primary source. So if you have 50% allocation to equities, you've got a 20-some% return already for the year. Our outperformance, of course, has come from being over-allocated to equities relative to our target and somewhat underweighted to fixed income, which has had actually the return for the fixed income index was negative for that period. And we've had a fairly strong positive return in fixed income as well. So overall, allocation as well as active performance contributed to a strong relative performance as well this year.
And you mentioned emerging markets. Your emerging market equities had the highest return at 50%. What do you think going forward, what you'll do with that allocation? Does it feel appropriate to stay where you are, or do you need to change that?
Yeah, so, we have a global equity allocation target that's about 45%. So that's broken into three segments: U.S. equities, developed markets, and emerging markets. So after having, nearly a 50% return, looking at the valuations and so on, currently we are slightly underweight emerging market weight in our portfolio, and we'll continue to hold that for some time to see how things will evolve. It's always the case that, when you had very strong performance one year, things will be a little more challenging going forward. So that's where we're at.
In terms of your performance, I imagine part of it is because you've been overweight the big tech names that have done so well over the last year or so, just looking at your top 10 holdings, both in the US and overseas. Are you getting a little bit nervous about any of those names, given the run they've had, given the possibility of rising rates?
Well, valuations are quite rich, as you know, right? So that's a concern overall, particularly in equities, particularly in technology. But I think what we're seeing is, strong earnings growth in those sectors. So that's seeming to support the current valuation. The economic growth continues to be strong. The PMIs are pretty strong across the board globally. And you have plenty of liquidity. I mean, the market is flush with liquidity, So all of this is tending, I believe, to support the high valuations that we have. But they're certainly high, and obviously forward returns would be much lower than what we've experienced in recent years. So that's what we are preparing for. So the highest allocations are to the usual suspects, and they are the big tech names. And technology is about 28% or so of the U.S. equity market. And so since we are nearly 60% passive invested in U.S. equities, we'll tend to have a pretty high allocation to those areas.